Welcome, everyone, to IGM's webinar series where we talk to the top investment bankers for their views about hectic global credit markets. I'm Shankar Ramakrishnan, the head of US credit and global market engagement at Informa Global Markets, based in New York. We are kicking off the series with a discussion about the prolific US investment-grade bond markets. The US IG markets are the largest in the world, and it saw over 1.7 trillion of bond issuance in 2025 by the largest companies from around the world. And they were busy again in January and February, setting new records for volumes. So before we proceed, just a note to our listeners, if you have any questions during the presentation, you can send them to us using the Ask a Question module on your screen. We'll try to cover as many as we can after the presentation and if the topic has not been covered. So the first week of February was also super busy, setting the record for the busiest February week in history. The month was also the second busiest February in history. So this frenetic pace of issuance is needed so that this year attains a new record estimate for issuance at a whopping $2 trillion. Up until last Friday, this market has sped along, despite volatility in equity markets on worries about AI funding and tariffs. But the US-Iran conflict this weekend paused primary issuance on Monday. Is this market still Teflon strong? And what will be the impact of the Iran conflict on issuance in coming weeks? Are the questions that will be answered today by Richard Wolff, the head of US Syndicate at SGCIB in New York. Welcome, sir.
Nice to see you, Shankar. Appreciate you having me on. Thank you.
Thank you, sir. And for a brief background, Richard has over 30 years of experience in US bond markets. He joined SocGen in 2010 to oversee the management and growth of the bank's US dollar high-grade bond syndicate. He was at Barclays for 12 years before this, where he covered Yankee, industrial, utility, sovereign, and financial issuers for the firm's US syndicate desk. So if there is anything, Richard has covered everything in these markets. So Richard has also spent 7 years at Lehman Brothers in both bond sales, trading, and origination capacities. So thank you again, Rich, for coming in and doing this with us. And let me kick off the questions. This week is expected to see an average 64 billion in issuance, and this month about 213 billion. Is that still a possibility after the conflict in Iran?
It's absolutely still a possibility. One of the things that the market has demonstrated over the course of the past year and a half is the resilience. And while there may be issues that arise on a fairly regular basis or even on a not so regular basis, the market has a real propensity to recover very quickly. And investors have gotten very good at bifurcating various types of risk. So while Monday is a quiet day in the US markets, I have every expectation that once investors digest all the information that's out there, we bounce back pretty quickly.
So what made people pause on Monday, you think? Like, is it like, I'm always curious to understand what questions do they ask on a day like Monday when they come back from an eventful weekend? What goes behind the decision on this go, no-go calls, as they call it?
Sure, and I think it's more the issuer's perspective rather than the investor's perspective on a day like today. And the issuers want certainty, right? They want clarity around what is this going to cost me? What is the new issue concession going to be? And what kind of size can I achieve with my execution? Right. And if there's any questions that come up around what we can deliver as an institution, then the issuer may take pause and say, let's wait for a little bit of a better window.
Right. So is it like a scenario where people are so confident of execution if they just wait out certain periods of instability? Is that how the market thinking is at this point?
Absolutely. And look, I mean, when we've had periods of crisis or periods of instability, they've been very brief. I mean, the market tends to recover in 2 to 3 days in a worst case scenario. So I think there's every expectation as an issuer that if the markets close today, that it may be open tomorrow. And if it's not open tomorrow, then it will more than likely be open the day after that.
Wow. And what is the confidence supported by? Is that the investor demand, or like how and why are people still buying the bonds?
So great question. And yes, it's a function of investor demand, right? Investors have so much cash. And you look at the investor community, which has grown massively to in excess of 500 separate investors. So we're in an environment now where there's a tremendous amount of demand. There's enormous amounts of cash chasing each issuance. You know, oversubscription levels have been very strong. We're at 3, 4, in some cases 5 times oversubscribed on each transaction. So investors are really looking for paper to buy, and the issuers are more than happy to supply it. We've been operating in an environment where new issue concessions are incredibly low. And so there's very little additional cost for an investor to achieve big size. You know, we've seen the size of transactions grow pretty significantly over the course of the past few years, where $8 billion, $10 billion transactions have become more commonplace.
Right, which is very interesting. We had like 2 deals from Oracle and Alphabet. They raised $45 billion between them. So coming back to like the whole AI funding thing as well, right? Like, do you think these kind of, like, if you're expecting 200 billion this month, obviously there's going to be large size jumbo transactions from maybe to support AI or M&A is expected. Do you expect that to still come this week maybe? And do you expect that to get the same kind of attention they got when Oracle and Alphabet came to the market?
Yeah, so very good question. So yes, I would have every expectation that if the tone settles, which it looks like it's already doing, that these issuers will be into the market. And I think the receptivity is going to be incredibly strong. You look at the Oracle transaction, and again, these larger transactions, we had a $30 billion transaction out of them, and the order book was $117 billion. So absolutely massive. So with the demand that is chasing that supply, we haven't seen that mitigate in any way, shape, or form. And so as we continue to see these transactions, we do expect investors to continue to participate because there is a reasonable concession that's being offered. I do think after a second trade and maybe after a third trade, you could start to see some fatigue. You could start to see investors saying we're a little bit full in the name, and that may have a long-term impact as far as the concessions that an issuer may be required to pay. But we have not seen that as of yet. The markets are incredibly strong and investors are jumping in with 2 feet.
So it's still early days in meeting the appetite for AI infrastructure build out, is what you're saying. Do you think they are not as worried as the equity markets about, you know, this whole leverage building by these large tech companies? That's not playing out in the credit markets, I guess, yeah?
We haven't seen it as of yet. It's a good question. We haven't seen it as of yet. Again, if we start to see 3 or 4 transactions of jumbo size throughout the course of the year, it wouldn't surprise me as we get into the third quarter, or maybe even the fourth quarter, that some fatigue is evident in the market. And in that case, you know, we'll figure it out when we get there. But we have yet to see that. And while the equity markets may be encountering a little bit more of that indigestion, if you will, we haven't seen it in the credit space.
And it almost seems like when the credit markets are a bit worried about some sectoral developments or you know, geopolitical risk, they ask for a premium in the pricing, which is reflected in new issue premium or new issue concessions. But the demand for the bonds remain high. So deal execution, however bigger the size of bonds, is still very much there, right? Like, is that something which still holds on even with this conflict and all that, like changes in sentiment? Do you see big order books continuing to support large issuances?
Yes, I have every expectation that the order books will remain significant. And I don't see this conflict as changing that. As I said earlier, the investors, excuse me, have gotten very good at bifurcating risk, and whether it's AI related. And look, there's a lot of names that can come that are related to AI hyperscalers, right? It doesn't just have to be the tech companies. You've got the utilities that need to provide the power, and you've got the construction companies that need to provide the infrastructure. So there's a number of issuers that could come to market related to this business, and we continue to see consistent, strong, sizable demand for each of these transactions.
Right. And coming to new issue concessions, Rich, like we have seen in February for a couple of weeks when the volumes were not meeting estimates, the markets were a bit volatile. You saw that new issue concessions had ticked up like a basis point or two, not a lot. But do you see that continuing? Do you see new issue concessions to remain where they are, which is pretty low, right, in historical standards? Do you expect them to remain low, or do you see them starting, like investors asking for a bit more compensation for all this, noise in the background, right?
Yeah, Dan, it's a great question. So yes, as we see an increase in noise, as we see heightened, I guess noise is the right word for lack of a better one, then yes, investors tend to want some type of concession for that, right? Because then you're looking at reductions in liquidity potentially. You're looking at, you're not really seeing a drop off in issuance. We think issuance will actually grow because what's going to happen is a period like Monday where there's volatility and no issuers decide to jump into the market. It just means that Tuesday and Wednesday will likely be more crowded. And so as an investor, if we're coming into a market where there's 17 or 18 deals to choose from, they're going to look for a slightly elevated concession as an incentive to participate in those transactions. And so as we see the number of transactions grow, yes, it wouldn't surprise me if concessions go up. But to your point, 1 basis point or 2 basis points, we don't view as significant. I think from an issuer's perspective, they don't want to pay any type of concession. But if we can keep it minimized to 1 or 2 basis points on a day when there's 20, 30 billion in supply out of 17, 18, 20 issuers, then that's a pretty good trade.
Right. And in terms of, credit spreads, like we have seen credit spreads ticking up, like they're still very close to the record lows. But do you see this to continue? Like, do you see credit spreads continuing to widen, at least in the next, couple of months or this quarter? And do you see that inhibiting investor demand?
I'm going to answer your second question first. I do not see it inhibiting investor demand. If I'm an investor and spreads start to tick a little bit wider, that's more of an incentive to participate. And what we've seen on the secondary side after transactions have cleared the market is that anytime there's been any semblance of a backup, 2, 3, and in some cases 5 basis points, investors have been absolutely jumping in to participate in good size. When you look at my thought process around where credit spreads are going to go, I think when we were at the index tights and we were in the low 70s, we clearly had asymmetric risk, right? I mean, it was the propensity to go tighter versus the propensity to go wider. There was clearly every indication that we were likely to go wider. And we've moved 12, 13 basis points off the index tights of the year. So we've had some movement. I don't view that as significant. We've had an offsetting move or more than offsetting move in the treasury market. We've seen 10-year rally 25 basis points in some of the highs that we've seen this year. And so as credit spreads are wider by 12 or 13 basis points from an index perspective, that's still not something that's not unappealing to an issuer. Issuers look at that and think, okay, this is still a very tight level. And I guess if asked the question, do I think spreads go wider or tighter? I wouldn't be surprised as we progress through the next quarter or even 2 quarters that we could see spreads continue to leak. And obviously the most recent events over the past weekend could be a contributing factor to that. And we've seen secondary spreads 2 to 5 basis points wider today again. So if that continues and there is that perceived weakness, and then we get inundated with significant chunks of supply, that's going to continue to put pressure on secondary spreads, which could push the index numbers a little bit softer. Do I expect them to be 30 or 40 basis points wider by the middle of the year or the end of the year? I do not. And that's based solely on the fact that the technical support that we continue to see from the investor community has been and will continue to be incredibly strong.
Right. Thank you for that. And can I ask you this, like what, in terms of investor profile, like you said, there's a widening of interest for high grade bonds at this point. Do you see any new batch of investors who are investing in this market? It was always dominated by the real large fund managers, but we are seeing a lot of Asian and Middle Eastern and European interests as well in these markets, right? Have you noticed any change, or has this been on for a while?
No, this has been going on for a while. I think that the sheer number of investors has grown. And I think if you look at the assets under management of the larger investors, that continues to grow pretty significantly. I think the hedge fund community has looked to become much more involved in the credit space as well. So we see them as much more active participants coming in for pretty big size.
Right.
But I don't think the composition overall has changed dramatically when it comes to the credit.
So it is when you say the market has got technically strong, you mean like the captive demand for high grade in itself is huge and it is growing basically, right? Like the demand for people who need to buy high grade bonds has actually grown over the years, I guess.
I think that the number of investors has grown, the size of those investors has grown. So yes, and I don't know if I would consider them captive because I think they're participating of their own free will and accord, but obviously they want their various allocations and they want X number of money, X percentage of their debt, of their portfolio, placed into the debt markets. And I don't see that abating anytime soon.
Thank you. There was one thing, like there has been obviously such a huge volume in these markets, right? Any particular deal which you have done or, your team has, or you have seen in the market, which thought was very interesting for you, like in terms of execution or structure, or what would you pick if you had to pick a deal? Which one would you say was an interesting one for you?
Yeah, it's a good question, Shankar, because I feel like each deal is different and each situation is different. And that's one of the wonderful things about our markets is that they're so dynamic. And you can look at, most recently we've had AbbVie and Abbott in the market doing 20 billion and 8 billion respectively. And those for that space were very well received, tremendous oversubscription, and they were big liquid deals, which investors really like these days. But I think you can swing it around and you look at some of the smaller transaction, $1.25 billion of a 3-year that we did for one of the captive finance companies with whom we transact. And that was incredibly well received. And they were able to attain very tight execution. And so to me, there's no one deal that stands out. I think it's actually the contrary, which is each deal tends to be very well received and each deal is a new story. And investors have gotten very good at bifurcating between the big AI transactions or the big pharma transactions or the small industrial transactions or the one-off names that are infrequent issuers. And each one of those, knock wood, has gone exceptionally well. And so I wouldn't say there's one deal specifically that I would point to that says this was the greatest. I think all of them have gone well, and it's a testament to investor education, investor ability to understand each individual credit, and the issuers being smart about when they attack the market.
Right. Okay, that's thank you very much for all that, Richard, and that's all we have time for, I'm afraid. Thank you again, Rich. It's always an honor and privilege talking to you, and we look forward to hearing more about how these trends may develop. If you have any feedback on today's webinar or any recommendations for future webinars, please do complete a short survey at the end of this webinar. It should flash up on your screen shortly. It has been a pleasure bringing you this webinar. So do keep a lookout on Informa Connect /IGM for the recording of this, other webinars and new analyst insights. If you like to find out more about IGM services and get a free trial, which you should, you can request that on informaconnect.com /IGM. Thank you and goodbye. Signing off.